$38 trillion. I mean, just try to picture that number. It's the kind of figure that just shorts out your brain.
It's astronomical.
Right. But for this deep dive, the huge number isn't actually the scariest part. The real question, the one we need to answer, isn't how much America owes.
It's who America owes.
Exactly. For, what, 20 years? The answer to that was pretty simple. It was stable. You had these strategic giants, China, Japan, our own Federal Reserve.
The price-insensitive buyers.
The price-insensitive buyers. They bought U.S. bonds for their own reasons. Geopolitics, currency management, monetary policy. The actual yield was almost secondary.
But that era is over.
Yeah.
I mean, completely and definitively over.
Okay, let's unpack this, because the data shows that this guaranteed bid, this stability, has been replaced by something much more fragile.
Yeah.
The biggest new buyer of U.S. debt is, and this is wild, a leveraged hedge fund, probably based in the Cayman Islands.
And that shift is everything. It's the key to understanding the new fragility baked into the entire global system.
So before we get to the Cayman Islands, let's clarify the debt itself. That $38 trillion number gets thrown around, but it's a bit misleading, isn't it?
It is. So the gross debt is $38.4 trillion, yes. But a big piece of that, about $7.6 trillion, is what we call intragovernmental debt.
The government owing itself.
Exactly. Think of the Social Security Trust Fund investing its surplus in special treasury bonds. It's really an internal accounting measure.
So if we push that aside, what's the real number, the one the global market actually trades and holds?
That would be the debt held by the public, and it's currently around $30.8 trillion. That is the collateral for the global financial system. That's the benchmark for the risk-free asset.
Okay, and the riskiness of that $30 trillion comes down to who is buying it. You've broken this down into two groups for us.
Right. It's a fundamental split. First, you have your price-insensitive buyers. These are the central banks, the Fed. They're buying for strategic reasons. The yield is almost irrelevant to their decision.
Their demand is predictable, stable.
Precisely. Then you have the second group, the price-sensitive buyers. This is everyone else. Hedge funds, asset managers, you at home buying a T-bill.
And they only show up if the price is right.
They only show up if the yield is attractive enough to compensate them for the risk. Their demand is, by its very nature, conditional, fickle even.
And the whole point of our deep dive today is that we are in the middle of this massive structural handoff from the first group to the second.
We are. The reliable buyers are leaving, and the opportunistic ones are filling the void. And that is forcing the U.S. to pay more to borrow, and it's injecting a huge amount of instability into the world's most important market.
So let's trace that exodus. Let's start with the biggest player of all, the Federal Reserve. For more than a decade, they were the ultimate price-insensitive buyer, right?
The buyer of last resort and first resort.
At their peak in 2022, the Fed held something like $6 trillion in treasuries, a quarter of the entire market. They weren't buying for profit. They were buying to run the economy.
And then they started quantitative tightening, or QT.
Which is a fancy way of saying they've stopped buying. They let their bonds mature and didn't reinvest the money.
They effectively became a massive net seller. And that move caused their portfolio to shrink by over $2.2 trillion by late 2025. You have to think about what that means.
That's $2.2 trillion that used to automatically flow back into the market, regardless of price.
And now it doesn't. Now every single one of those dollars has to be absorbed by the private market, by those price-sensitive buyers who demand a higher return.
And even though the Fed has slowed down the shrinking recently, they're not buying more. They're just on the sidelines. The biggest buyer in history is just gone.
And it's not just a domestic story. The same thing is happening with foreign buyers. Their ownership of U.S. debt has just collapsed. It's gone from nearly 50% in 2011 down to about 29% today.
That subsidized foreign bid that we took for granted for decades is just evaporating.
It really is. And if you zoom in on the players, it gets even more dramatic.
Let's talk about Japan. Still the biggest foreign holder with about $1.1 trillion. But their role has completely changed.
Completely. They are no longer just a stable strategic buyer. We've seen it over the last year. When the yen gets crushed, what does the Japanese Ministry of Finance have to do?
They have to defend it. They have to sell dollars.
Which means selling treasuries. So the country that was once the bedrock of stability for the treasury market is now a potential source of massive, sudden selling pressure right in the middle of a crisis.
Wow. And then there's China. That story is even more stark, and it feels purely geopolitical.
It is. A decade ago, China held over $1.3 trillion in U.S. debt. Today, that's down to around $760 billion.
A drop of more than $500 billion. What was the catalyst for that?
I think the real turning point was 2022, when the West froze Russia's central bank reserves after the invasion of Ukraine.
A light bulb went off
The
invasion.
massive one. They learned that U.S. debt is a conditional asset. It's only yours as long as you're on the right side of Washington's foreign policy.
So they're de-risking. They're moving away from the dollar system.
Actively. And their diversification strategy is pretty clear. They're buying things that can't be frozen. For the last 2 years, the People's Bank of China has been one of the biggest official buyers of gold on the planet.
So when a player that big makes a conscious decision to step away, it shrinks the whole buyer pool.
And it directly drives up the cost of borrowing for the U.S. Treasury.
Okay, so the giants are retreating. The Fed is on the sidelines. China and Japan are either selling or diversifying. But the U.S. is still issuing trillions in new debt. So who's buying it? Who stepped into that vacuum?
Well, the first answer might surprise you.
American households.
American households. For 15 years after the financial crisis, with rates near zero, nobody wanted a Treasury bill paying 0.5%. All that money went into stocks, real estate.
Chasing yield, yeah.
But the return of 4% and 5% yields changed everything for the regular investor. Suddenly, you can get a decent, safe return on your cash. So households and mutual funds now hold over $4.4 trillion.
Which on the surface sounds great. Domestic savings funding domestic debt.
It sounds good, but remember what kind of buyers they are.
Price sensitive.
Highly price sensitive, which means that capital is fickle. If yields fall or the stock market starts a huge rally, that $4.4 trillion could rotate right back out of treasuries just as fast as it came in. It's sticky, but only for now.
Okay, so that's the fickle money. Now let's get to the alarming part. The second major new creditor.
The hedge funds.
Specifically, if you look at the official data, you see this one tiny country holding a shocking amount of U.S. debt. The Cayman Islands, $427 billion.
It's more than France, Canada, and Germany hold.
Combined.
And we're not talking about the 70,000 people who live there. We're talking about something else entirely.
We're talking about the statistical footprint of the basis trade. This is a massive leveraged arbitrage play run by hedge funds that are domiciled there for tax purposes.
Okay, break that down for us. What is the basis trade? In simple terms, they buy a cash treasury bond, and at the same time, they sell a very similar treasury futures contract. They're trying to capture a tiny microscopic difference in price between the two.
And to make that tiny profit worthwhile.
They need incredible leverage, sometimes 50 to 1.
Wait, 50 to 1 leverage. To make a profit on this tiny trade, you're essentially betting the entire house that the market stays perfectly calm. Is that really who is setting the price for U.S. debt now?
That's exactly what researchers at the Fed have confirmed. They identified these leveraged speculators as the marginal buyers of long-term U.S. debt. In 2024 alone, these funds soaked up 37% of all new long-term notes and bonds issued.
Over a third. We've swapped out stable central banks for highly leveraged speculators. That is an astonishing change.
And there's a third piece to this new creditor puzzle, money market funds. They are sitting on a mountain of cash, something like $7.5 trillion.
A huge pool of domestic liquidity. That sounds good.
It seems good, but there's a huge catch, a structural problem.
Which is?
Money market funds, by law, can only buy very short-term debt, stuff that matures in under a year. But the Treasury needs to issue long-term bonds to manage its debt profile and lock in funding costs.
Ah, so there's a mismatch. The biggest pile of cash only wants short-term bills.
Right. And this forces the Treasury to rely more and more on issuing short-term debt that has to be rolled over constantly. And that builds up a huge amount of refinancing risk. The risk that one day you go to roll it over and the market demands a punitive price, or it isn't there at all.
So let's sum this up. The new ownership coalition is fickle households chasing yield, money market funds forcing short-term borrowing, and leveraged hedge funds playing a risky arbitrage game. We've replaced patient money with hot money.
And this brings us right to the heart of the matter, what we call the marginal buyer problem.
The marginal buyer being the one who actually sets the price at the auction.
Exactly. The person who steps in last to clear the market. When that was the Fed, they didn't haggle, they just bought. They were insensitive to price.
But today, that marginal buyer is the hedge fund running the basis trade.
Correct. And
Yeah.
they will only buy if that tiny spread is profitable and if their funding, the repo rate they use for leverage, is dirt cheap. If repo rates spike, they vanish. If volatility picks up, their leveraged bets can blow up, forcing them to sell and pulling all that liquidity out of the market instantly.
So you're saying the stability of the entire U.S. government's funding now relies on the continued profitability of a leveraged hedge fund trade.
That is the dangerous feedback loop we've built.
Mhm.
The one market that is supposed to be the anchor of global finance becomes the most fragile right when you need stability the most during a crisis.
We already saw a preview of this, didn't we? Back in March of 2020, the Treasury market just froze.
It completely seized up, the plumbing broke, the Fed had to step in with over $1 trillion in emergency purchases just to get it functioning again.
And the scary part is that the situation is even more precarious today.
That's right. The kindling has accumulated, as one analyst put it. The total hedge fund exposure to this basis trade is now estimated to be over $1.85 trillion. That is substantially larger than it was when the market broke in 2020.
We've structurally engineered more fragility into the world's most important asset.
And you have to add the geopolitical layer on top of that. The weaponization of the dollar via sanctions has split the world. Our allies are still buying, but our rivals and even neutral countries are actively looking for alternatives. That shrinks the overall pool of strategic buyers and forces the U.S. to offer higher and higher yields to get its debt auctions cleared.
Okay, so let's bring this all home. For you, listening to this, trying to understand the health of the markets and the economy, what does this all mean? What are the bottom line implications of this shift?
I think there are three big ones.
First, the idea of a risk-free rate is sort of a misnomer now. The credit risk is zero, America won't default. But the plumbing risk, the risk that the market itself can break down, is very real. And that would force the Fed to intervene in ways that could mess with everything from inflation to rate policy.
Second, interest rates probably have to stay higher for longer than people think. That subsidy we got for decades from strategic buyers is gone. Yields now have to be genuinely attractive to keep the price-sensitive crowd, the households, and the hedge funds at the table.
And third, the Fed's independence is really only conditional now. If the Treasury market blows up, the Fed has to step in and fix it. That's its primary job now, even if it means abandoning its inflation fight. We saw the Bank of England get forced into that exact corner in 2022.
Exactly. Market stability now trumps price stability.
In the end, it seems the composition of who owns the debt is just as important as how much debt there is.
It's the crucial factor. $38 trillion owned by patient, long-term capital is one thing. It's manageable. That same amount owned by a fragile coalition of speculators and yield chasers is a powder keg.
And the real danger, this debt spiral people talk about, it isn't an outright default.
No, not in a country that prints its own currency. The real danger is the market demanding higher and higher yields to absorb more and more debt until the interest payments themselves crush the economy or until one of those leveraged players breaks and triggers a liquidity crisis.
We've spent this entire deep dive on who owns the debt. But that leads to a final, really fascinating question.
Which is, where are all these higher interest payments actually going? Who is collecting on this massive bill? If you follow that money, it reveals a massive, quiet wealth transfer that's hiding in plain sight. Something for you to think about until our next deep dive.